For its size, the Isle of Jersey boasts incredible financial power, an outgrowth of the island's status as an offshore haven. But how does Jersey, an English-speaking isle off the coast of France, compete with the Cayman Islands or even other British Isles to attract hedge fund and asset managers? For answers, we turn to Jeff Cook, the chief executive at Jersey Finance.
We've been working very hard on what those kinds of firms need. I think they need certainty of establishment, they need speed to market, and simplicity, not a complicated operating environment. So everything we've been doing over the last 18 months, 2 years, has been geared to deliver those objectives. So we've got a full suite of different fund regimes now, from heavily regulated retail type orientation to a middle ground of fast track approvals but still regulated, to an unregulated offering for very high value sophisticated investors. So we really are trying to modernise the jurisdiction and meet the needs of potential fund managers and service providers. As far as the hedge fund community as a whole is concerned, I think we are interested in attracting them to Jersey as fund managers, as asset managers. Our fiscal regime now is very attractive. For fund managers, you're essentially in a 0% corporation tax regime, and many of these folks tend to be high earners. So from a high value earning point of view, we've got a very favourable but transparent and understandable tax regime. You know, it starts at 20% up to a certain value level, but over 1.5 million it's 1%. So it's graduated, it's simple, it's not a sort of a special deal or contingent on this or that. And we believe that for many European-based hedge fund managers, we're attractive because we've got the English language, you've got an education system and an environment that feels familiar. It's a bit warmer, a bit more attractive, we would argue. But it's an easy place to transition to, and it's a welcoming place. You know, we've got a flexible regulator, but as you've heard this evening, with a strong reputation, good strength and depth in our professional expertise, our advisory firms, and we're welcoming of new entrants.
Jersey has also looked for friends outside of the United Kingdom, particularly in Asia.
Traditionally, Jersey was very much drawing its business from the UK, either domestically or through the international business that's cleared through London, and that's still extremely important to us. We continue to be totally committed to servicing that market, but we are looking at market diversification. We will have visited China, I think, 4 times by the end of this year. We've been to Hong Kong, to Shanghai, to Beijing, and we're promoting our company formation and sort of listings capability out there. We've been to India on an exploratory fact find, received a very good welcome both in the funds universe and in the private client field. And we've been actually active in the Middle East for about 5 years now, so 20 plus Jersey firms have representative offices or personnel resident in the GCC countries. So if you took our sort of value footprint and took currency as a proxy for diversification, only about a third now of the value in Jersey is in sterling. The other 2/3 is in lots of other currencies, and we have clients now in over 200 countries around the world. So we've, in the last 5 years in particular, and I guess in the last 2 years in terms of acceleration, we are diversifying and getting into emerging markets, some of the BRIC countries, but particularly Asia, Middle East, Indian subcontinent.
Jersey has always resisted installing regulations as tight as other markets. But can Jersey maintain its laissez-faire attitude while regulators worldwide move to curb risky trading?
Well, our approach to regulation over recent years has been really to subscribe to international standards, the highest international standards. So in the funds world, we're subscribing members of IOSCO as a jurisdiction, and we have worked very hard on corporate governance. So we kind of feel our standards are pretty high already in terms of comparisons perhaps with the kind of the rest of the funds world.
Cook did say, however, that new regulations are not inconceivable.
The kind of regulation that may come in, I think, might impinge much more on banking than perhaps directly on the funds area. It might have a sort of a second order effect on fund type business. And that could be about the degree to which risk sits on your balance sheet, the degree to which if you pass assets off your balance sheet you retain some kind of obligation or responsibility, and to what extent. I think we could see change there. I think we could probably see change with the risk rating agencies and their relationships with investment houses in terms of rating funds, rating debt and that kind of thing. I would expect there will be some regulation in that area. There's speculation about short selling at the moment. There's been short-term prescriptive measures taken on short selling. I would be surprised if they stick. Because interfering in markets with mechanisms to prevent the use of legitimate tools could have an unintended consequence. It's having a tool. It's not necessarily the tool that's the bad thing. It's the deployment and use of the tool that could be the issue. So we will watch events carefully. We'll watch the US approach to any regulatory changes they make. The UK. We already operate, I would say, to a good standard. And if regulation comes in that looks sensible, structured, appropriate, then more than likely we will adopt it. If, however, we get things that look a little bureaucratic and are not really offering a great deal of additional investor protection, then we may well opt not to adopt new measures in quite the same way as some of the larger onshore economies.
This is Justin Thompson with producer Eric Hornbeck reporting from London.